All right, good afternoon, ladies and gentlemen. So if you missed last class, I'm out today, but this will hopefully help you catch up a little bit. And if you're just like kind of a little bit lost or you just want to make sure you're on point from last class, you can watch this real quick here. So what we're doing is we're moving into this section where we talk about production costs and how the firms are going to make decisions. And essentially your question is this one here is, so if Mr. Sutton is opening up a new bakery, how's he going to think about his success? And in class, you guys talked about a lot of things. He said, well, maybe we're going to judge it based on how many dollars he brings in. So in other words, his revenue. Other people said, well, yeah, we can't worry just about revenue, though, because we got to worry about like how much it costs to buy the ingredients and stuff. And those people were talking about profits. And then some of you said, well, what about like, just maybe his level of stress or his level of satisfaction with his job? Maybe if he just enjoys it, like that would be enough to be successful, right? And so what we're going to do is we're going to look at how Mr. Sutton might or other firms might judge their success today. And so this was your entry question from the other day, and it asked for what types of cost would Mr. Sutton incur. And you guys had a bunch of them on the board, and I just kind of took the ones that I could remember. And we have two categories here. Over here, you've got things that you actually like shell out money for to make your product, and in this case for Mr. Sutton to open his bakery. And all these work, right? And these are what we call explicit costs. And I'll put that in the slide in just a second. If you didn't get the worksheet last class, you'll write it down in just a second. Now these ones over here, though, they're costs too. Like all the time that I put into setting up my shop, I couldn't spend doing my last job, or I couldn't spend in another job, or spend with my family, and those are costs too. But these are more like your opportunity costs. And opportunity costs are what we call an implicit cost. So it didn't cost me in the sense that I had to take money out of my pocket, but it's that I didn't get to put money into my pocket. And so if you look at your sheet, it's like this. And so explicit costs, we just looked at a bunch of examples. I put sugar, but I had factory. So you actually spend money on these. Whereas your implicit ones, there's no money changing hands here. And so for Mr. Sutton, if I could have spent my time as a professional basketball player, that's probably not true for Mr. Sutton, but maybe my time as a teacher, right? If I'm spending all my time trying to open up or work in my shop that's a bakery, I probably can't spend my time during the day teaching you and making income in that way, all right? So those are two ways you could categorize it. And then during class, before we get there, so look at two questions here. If you haven't seen these, pause your video for a second and try them, and then I'll talk to you in a second. So pause if you haven't seen it already. Try it on your own. All right. So an implicit cost, something that doesn't incur an outlay of money. Well, tuition I pay for. That comes dollars and cents. Books I pay for. My laptop computer I pay for. Student activity pay for. Activity fees, I'm cutting a check for that. But getting a job at McDonald's, well, no, I'm not paying for that. But if I attend college, I might not be able to have a full-time job, or probably won't be able to have a full-time job at McDonald's. So that is my implicit cost. Now down here, Bill's got $1,000 of his own money to buy all the materials. And what I ask is for explicit and implicit cost. So the explicit cost for Bill here, let's see. Well, he spent $1,000 on his machinery and his materials. So that's an explicit cost right there. And he quit his old job as an eggshell peeler where he earned $500. So this $500 is an implicit because that's foregone wage. He didn't pay anything for that, but that's an implicit. Now, the bank gives borrowers and savers the same interest rate of 20%. Well, some people in class were like, I'm not sure, Mr. Sutton. Well, think about what he did. He chose to spend his money as opposed to saving his money. Had he saved his money, he could have gotten 20% interest, which would have been a fantastic rate, and that would have been $200. That $200 is a cost, and it is an implicit cost because he couldn't earn interest income. On the flip side, had he taken out his $1,000 loan, if this had been a loan instead of money from his bank account, then the $200 would have become an explicit cost because he'd have been paying the bank for the use of their money. a service that the bank provides. So hopefully you did all right there. If not, ask a classmate, because most of the people in class seem to have a pretty good handle on this today. Now we could also categorize these a little bit differently. We could do fixed or variable costs. So fixed costs, somebody brought it up. I think Tabitha brought it up in class. Hey man, this is like a one-time cost. You pay it. It doesn't matter what your output is. You're going to pay the same amount of fixed costs. And so we had lots of examples. Rent might be an example. The one that came up in class might be like an oven. Maybe a spoon. Think about it. If you're a baker and you buy one spoon, you pay that cost one time, right? You can make thousands of cookies. And the cost is the same whether or not you make one cookie or 1,000 cookies. Now your variable costs, though, are different. These vary with your output. So a spoon wouldn't be that, but maybe sugar, flour, eggs. Because if you want to make more cookies, more danishes, you're going to need these items. Now, we got into a huge thing about wages and whether they're fixed or whether they're variable. So if you have an hourly worker and you want to produce more danishes at your bakery, you could pay them more and they would produce more. And so in that sense, they're a variable cost. Now, some people want to say, well, maybe they're a fixed cost if you had a salaried worker. So somebody like Mr. Sutton, or let's say Mr. Sutton, who has a fixed wage, whether I work, 10 hours a day or 5 hours a day, I get the same amount of money. Well, in that sense, maybe it is a fixed cost. And also the thing that came out was over time, all of these become variable costs. Because if you think about it, man, if I want to make more cookies someday, I might buy a new oven. I might buy 3 ovens. I might need 10 more spoons. And because I run out of production capabilities of 1 spoon in 1 oven. So more time means you have more variable cost. And then to figure out your total cost, you're just going to add the two together. Now, total revenue we figured out before. This is the amount the firm receives. So it's our price times our quantity. Those are the dollars in. Total cost, add up all your fixed and your variable costs. And then our profit uses these two things to figure out what's left. Now, the thing is, we talk about how we calculate these costs, or these profits, and it's different depending on who you talk to. So, economic profit, you're going to take your total revenue, and they'll include explicit and implicit costs. But when you worry about accountants, when you talk about accountants, they only worry about explicit. They only worry about dollars in and dollars out. Okay? Which means that your economic profit is always going to be smaller than your accounting profit. And so they have this like fancy little word here. It's called your normal profit. Normal profit is a situation where your economic profit is 0. And if your economic profit is 0, what has to be true about your accounting profit? Well, it has to be greater than 0 because look, they don't include those implicit costs. So they include fewer costs. They have to be bigger than 0 when they calculate your profits. What I want you to do, if you haven't done so already, I want you to try this one, and this one. Okay? And then check yourself in the next video.